By definition, a stock is a unit of ownership in a company. If you own a stock, that makes you a shareholder. Stocks can be either common stock, which gives shareholders voting rights on certain company decisions, or preferred stock, which gives shareholders no voting rights, but often guarantees them periodic fixed dividend payments. But let's use an example to better understand this concept. This is Alex. Alex wants to open a cake shop, but he doesn't have enough money to buy all the equipment he needs. He needs $100,000 to open his business, but he only has $50,000. Therefore, he decides to sell stocks to investors to help raise money. Stocks are pieces or shares of ownership of a company, and each share is worth a certain amount of money, based on the company's worth. Alex needs to raise $50,000 to open his cake shop, and he decides to divide his company into 100 shares, and sells 50 shares at the price of $1,000 each to the public. This is called IPO. Initial public offering, which is a company's first time offering its stocks for sale to the public. After selling the 50 shares, Alex has successfully raised the necessary money to open his business, while giving up 50% of the company's ownership to shareholders. Now, if his company does well, and investors are confident that the business will experience growth, they might start buying stocks. As demand for those stocks increases, so does the price. However, if Alex's cake shop starts to seem less profitable to investors, the demand for stocks plummets and so does the price, as shareholders decide to sell their stocks before the company loses value. Now, this is a simplified explanation with the aim of giving an overview of this concept, but things are a little bit different in the real world.